Hi, I'm Steve LaFrance with Blakely Financial. January's markets gave us some wild volatility, so let's try to make some sense of how things are going. One of the primary headlines affecting investors is the expectation of the Federal Reserve preparing to tighten monetary policy by ending its monthly bond purchases and raising interest rates. Asset purchases were initiated during the pandemic as a way to inject money into the economy by buying bonds to help lenders continue lending. Interest rates were lowered to decrease financing and debt servicing costs. Together, this stimulated demand during the depths of the pandemic. However, the two monetary policies appeared to have done too good of a job. Inflation rose 7% year over year during 2021, the fastest pace since 1982. Now the Fed is preparing to reverse the two policies and tighten financial conditions to dampen strong demand. The markets responded with the S&P 500 down 5.3%, international stocks down 3.6%, small caps down 9.5%, investment grade bonds down 3.6%, high yield bonds down 2.7%, and the emerging markets were flat. Interest rates rose in anticipation of the Fed's actions, bringing yields near January 2020 levels. This led to higher real yields, which is the yield earned after accounting for inflation. Figure 1 shows real yields rose this month after touching a record low in 2021 due to a combination of high inflation and near zero interest rates. 2021's deeply negative real yields caused investors to turn to riskier investments to generate positive after-inflation returns. And then there was a broad rotation in the equity and credit markets during January. De-risking was a prominent theme as real yields rose and traders adjusted their portfolios. The S&P 500 and Russell 2000 indices both traded lower, and all but one of the 11 sectors traded lower. Trading action was volatile at times, with swings of more than 2% each day from January 20th through the 28th. There were also multiple performance trends worth mentioning. Figure 2 shows growth underperformed value by 6.7% during January, its fourth biggest month of underperformance since 1994. Growth stocks are priced based on their future earnings, and rising interest rates tend to decrease the price-to-earnings multiple markets place on those earnings. In the credit markets, bonds generated negative returns and did not offer protection from the equity market sell-off. Finally, cryptocurrencies plunged during January, with Bitcoin falling nearly 20% as speculative assets saw aggressive selling. 2022 is clearly off to a difficult start, but it is important to keep the big picture in mind. Figure 3 graphs the S&P 500's price return and maximum pullback for each year since 1986. The chart shows the S&P experienced an average maximum pullback of 14.2%. For comparison, 2021's maximum pullback was only 5.2%, or almost 10% below the average, which is the exception, not the rule. Volatility is the price of admission for investing and will continue to impact portfolios. Experiencing market sell-offs is always unpleasant, but the chart shows annual returns historically finished the year well above the maximum drawdown level. As I mentioned last month, the transition away from government stimulus will continue to drive volatility, but data still indicates the U.S. economy is growing, the consumer is strong, and the recovery is progressing. So stay the course, and thank you for your trust and confidence.